Okay, good afternoon, class. This is Professor Kerry. Hope you guys are enjoying your snow day, holiday. It's kind of nice, first one. However, bad news, we still have to keep moving. So, we only have 2 weeks left of school, so we do need to work on this chapter and keep moving ahead. So, enjoy your day, but be sure to work on Chapter 12 on your time off. So, Chapter 12, last week we stopped at slide 13, so I'm going to just pick up where we left off and keep moving and wrap up this chapter. So chapter 12, capital market history. So we stopped here. This slide here represents different investments, different returns, and because they have different returns, they're going to have different standard deviations because, for example, small stocks return 16.9% on an average over a long period of time. But because they return such a high return, as a result, they're going to have a high standard deviation, meaning that return can really swing from the left to the right. It could do as well as 32%. It could probably even do higher than that, or 16%. It could do higher than that, but it could do much lower than that as well. On average, that's your return, but it has a lot of wiggle room. It deviates. It has a lot of variance. Unlike the Treasury bills, you don't get a huge return, but there's not much wiggle room. They're pretty solid, locked in on that return. So you can see the different standard deviations on the different instruments. And as you get a higher return, generally that standard deviation is going to be higher as well. So let's see how we come up with that. We will dive into this a little deeper in the next chapter, and you guys have probably worked on this in stats, I hope, at some point at New Paltz. But here's a simple example. One stock, 4 years of returns. Okay, so we want to find out what is the average over that span of time. Keep in mind that 4-year span of time is a sample. It's not the full population. It's not every year that stock has had a return. If we looked at that of course would be called the population. And the formula works slightly different under population and under sample. Okay, so we have a sample of 4 years for, call it XYZ stock. The first year, or one of the years in the sample, returned 15%, 1 year 9%, then 6%, then 12%. Okay, so we want to get the average, and that's a key point here, the average. The average is adding all these up and dividing by 4. Okay, simple math that we've all done. And that is 10.5%. So that's our average. Now what we want to come up with is what is the variance, and then what is the standard deviation. Variance is how much it varies from the mean, from the average. Standard deviation is how much of that deviation, what percentage of that deviation is one standard deviation, and what is that percentage. Okay, they're very similar, but they do represent different things in the terms of stats, and we'll kind of show that. Okay, so we get the average. That's step number 1, and we just drop that into this column. Now we want to see how much that each data point varies, hence variance, varies from the mean. Okay, so we go 15 minus 10.5 is 0.045, 9% minus 10.5% is a negative 0.15, and so forth. So we do that for each data point. Okay, then we want to square that. Not square root, but square it. Take the second exponent. Okay, and that does 2 things for us. One, As you may have recalled from stats, it will remove all the negatives. Okay, negatives are hard to work with. Number two, it's meant to put more weight on those that lie further outside of the mean. Okay, so removes the negative sign and puts more weight on those that are further from the mean. So we do that, a minus b, square it, a minus b, square it, do that for all four, and then simply add those up. And we get 0.0045. So that's what we did here. Now, because it's a sample, we add all that up and we divide by 4 minus 1, which is 4 is the n, the sample number. And because it's a sample, sample calculation, you do n minus 1. So 4 minus 1 is 3. So we take the 0.0045, that was a total number that we received, divided by 3. And that gives us 0.0015. That's the variance. Once we have the variance, the standard deviation is easy. It's simply the square root of that number. So the square root is 0.0387 or 3.87%. So one standard deviation is 3.87%. Two standard deviations would you would double that number. 7 point something. 3.87 times 2. Double that. That would be 2 standard deviations. 3 would just simply be 3.87 times 3, going to the left and the right of the average. Okay? And again, next chapter we'll get more into what that means. Okay. Times the 2 periods. Okay. Equals 1. Okay. That's to the 2 periods. Equals 0. So, but we're going to work on how we figure that out. Okay. So basically you put a 100%, 1 plus a negative 50 is 50. 1 plus 1 is 2. Multiply those two together and it's over 2 periods and you get 0%. But let's look at that in more detail. This is growing at, the average growth the average return is 4%. We want to see what the average here is, or that we received, by multiplying everything together. Okay, so that's the ending number. We start at -1. Future is going to be that number, and then if you run the calculation, you come up with 3.66 if you calculate for I. Okay, and that is the growth under a geometric average. That's a return for the geometric return. So, and that should make sense. That's more authentic. That's really measuring the whole period, not just, 1 year to the next. It's really the cumulative effect. So if we look at geometric and arithmetic, geometric average tells you what you actually earned per year on average, compounded annually. Again, we've been looking at compounding and discounted interest. So the compounding effect of that earnings is 3.66. Arithmetically, it only tells you what you can earn in a particular year on average. Okay? So arithmetic is focused on one period of time. Geometric is really the whole scope of the whole time frame. That's the crux of the difference, the crux of the matter. Okay? Again, we are using both systems because it might be this arithmetic is too high for long periods. Geometric is too low for shorter periods. So we sort of come in between that, combine that. Okay, we have this. 25 years of data. Okay. We have this, and we want to forecast 5 years. Okay. Now, just as a little qualitative note, the equilibrium market hypothesis, that tells us it's a theory in finance, and basically what we've talked about in class is stocks are, when they're in equilibrium, that when they are in equilibrium, that is the intrinsic value. So this buying and selling back and forth when stocks are overpriced or underpriced, a lot of buying and selling take place. But it continues to get it back to equilibrium, and then things kind of fall out of place with this noise, gets out of equilibrium, buying and selling take place, gets back to equilibrium, and keeps doing that. So that's the efficient market hypothesis, that the market is constantly trying to make those stocks efficient. This is just from the book that you can basically see what happens. This is really when the market's efficient. But what happens is before and after that time, people are late to the party, so to speak. So buying and selling can happen. And so when the price, before they've made it to the equilibrium price, people are buying and selling. And then efficiency happens. So on average, you will earn a return that is appropriate for the risk undertaken, and that there is no bias in prices that can be exploited to earn excess return. But there are some times before that data gets out to the public, and that's what insider trading, when people have that insider trading information before it becomes public, they have an advantage. That's obviously illegal, but that's what some of these people that have been placed in jail gather that inside information before it's really public knowledge, and exploit that information. So, in conclusion, intrinsic values of stocks we've talked about. The equilibrium takes place, and result of that is buying and selling. That keeps the market in equilibrium because of pricing that's over or under equilibrium. Okay, and different financial products have different standard deviations and variances based on the returns that you are getting.